Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 10th of July. I'm Daniel Lam, your host for the podcast. Well, last week, one of the most prominent macro moves was US 10-year yield going over 4%. Now, of course, this is a major psychological level and may signal an exit of the quote-unquote comfort zone that I've been mentioning so often for many risky assets. Thus, this makes macro data, such as the non-farm payroll numbers last Friday, extremely important to watch out for. Now, on the surface, the lower than anticipated job gains suggest that US labor market conditions softened last month. However, the 4.4% year-on-year increase in average hourly earnings came in above the anticipated 4.2% year-on-year rise. Average weekly hours worked inched up to 34.4 versus the consensus estimate of 34.3. And the unemployment rate ticked down from 3.7% to 3.6%. So the hotter than expected wage data basically signals that employment conditions remain resilient and likely means a 25 bips rate hike later this month. On the inflation front, Wednesday's CPI release will be the last inflation update ahead of the FOMC's decision. While it is likely to show price pressures are subsiding, a soft inflation release probably will not be enough to stop the Fed from hiking this time. So it appears that as long as employment conditions remain resilient, the Fed is likely to maintain policy at restrictive levels. So how should you be positioned? Well, we did spoke about high-quality bonds offering value to enter comparing to US equities. We would like to expand a bit more on that today because the Nasdaq 100 index has hit its resistance at 15,260 a couple of times this year, and so far had failed to break the resistance. So now it is time to think about what we've been discussing for the last couple of months, that there could be some rotation out of the hot US technology stocks for the short term, because investors may start to feel a little bit uncomfortable in their comfort zone, just a little bit. And this may induce them to rotate some of that holdings into the cheap Chinese equities. Now, there have been positive factors there, such as a relatively amicable meeting between Yellen and the Chinese officials over the weekend, and also talks about a final fine on the Ant Group from Alibaba, which boosts sentiment that relationships may be on the mend between the Chinese government and the bellwether technology companies in China. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.